watching The Money Show, the daily destination where smart money meets smart strategy. That's right. Whether you're building wealth, protecting your portfolio, or just trying to make your money work harder, you are in the right place. Markets move fast, and every day we help you stay one step ahead. I am Kavita Thapliyal, and all right, let's talk money. And today, we'll focus on something very important. Markets rarely move in straight lines. That's right. They rise, they fall, they surprise us. Often when we least expect it, and in those moments of uncertainty, many investors freeze or worse, rush for the exits. But seasoned investors know a different truth. Volatility isn't just risk, it's opportunity. It's the engine that creates mispriced assets, discontinued entry points, and long-term wealth for those who understand how to navigate it. So today we are unpacking why market volatility can actually work in your favor. You must have heard this a lot, but then how to separate emotional noise from real opportunities, and how smart investors position themselves when market gets shaky. So if you've ever wondered when to invest, how to stay confident during market swings, or what strategies professionals use in turbulent times, this conversation is for you. So let's dive right in. I have with me Vishwajeet Parashar, the mutual fund expert, who will be helping you navigate all of this. Vishwajeet, hi, good evening and welcome to the show. So volatility is your friend. It can be your secret weapon also, okay? So when most people hear the word volatility, they think risk. Now, you are a professional. You've been in this industry since many decades now. Why do professional investors often see opportunity instead?
Absolutely right, Kavita. When you say volatility, a lot of people understand it as a risk, whereas volatility means the prices can go up as well as down. So it is not that it will always go down. First of all, that should be very clear. And normally volatility increases when there are certain uncertain events like maybe election results, or there is a geopolitical issues or war. So these kind of days, in certain events, the volatility index increases. However, if you see today's volatility also, it is not very high. It is in the range of 11 to 12. Whereas mostly it is range bound between 11 to 17. When it is more than 17, then there is a certain concern that the markets are going down. But otherwise, it is very range bound, so there is nothing to worry about as of now. And if you look at last 52 weeks highs and lows, the index has gone, the volatility index has gone from 8.5 something to 23 point something. So we are in the range of 11 to 12. So first of all, there's nothing to panic about it. And there's a very slightly increase in the volatility. Now, when you're entering the equity markets, it is very clear, we all know that markets will go up and down. It cannot always go in the upward direction. So sometimes correction is healthy for wealth creation, and that is what it all means. And when there is a volatility, one should take the advantage of it rather than having panic or concern. So first of all, I would say normally people try to time the market, and that is where they get wrong.
Right.
Timing is not important. How much time you are in the market is important, and more importantly, if you can diversify your portfolio, if you can in a disciplined way invest, like systematic investment plan is a great tool to beat the volatility. So these are the things which you can.
So SIP always works like a magic wand, but let's just take a step back, Vishwajeet, because investors trust a lot of data, okay? They trust proof. Now, historically, since you've been around since a very long time, you've handled and you've tackled various kind of clients, especially the ones who are very fidgety during volatility. So historically speaking, how have periods of high volatility rewarded long-term investors? If you could just give us some examples.
Absolutely, Kavita. So point is very simple. Whenever there is a volatility, the markets are down, let's assume. And if you, in a panic, if you sold, then, and you normally see the average of SIPs in our country, it is in the range of 2 to 3 years. So maximum people continue with their SIPs in 2 to 3 years. So if you continue, if you see the historical data also, let's say you start from 2000 to 2025, and if somebody has continued their SIPs, amazing kind of wealth one would have created, because you see all the kind of ups and downs have come, whether there are wars, whether there are COVID, and one very clear example is COVID. lot of people have sold their investments or in panic that there is a COVID and there is an uncertainty. But people who have continued, invested, or they have continued their SIPs, they have created a great amount of wealth, and that is how you can take advantage of this volatility and uncertainty.
All right. Talking about the trigger of volatility, what actually causes market volatility? Is it fundamentals? Is it news cycles, investor psychology, or all of the above? How can everyday investor tell the difference between normal market fluctuations and true warning signals?
Yeah, absolutely. So, Kavita, if the market's in a range bound, like in these days, last 1 or 2 months, if you see the markets are quite in a certain range,
right?
Then there is nothing to worry about. But if investors are there is a lot of selling going on. Let's say FIs are selling aggressively. So right now we are getting 30,000 crore SIP every month. But if you start getting the number that 30,000 crore is getting sold, then that is the time you should be alarmed, and that is the time you should take, review your portfolio. It doesn't mean that you have to sell also, but you have to review your portfolio or reallocate between equities and debt. That is how you can manage, these uncertain times. But having said this, the present scenario is nothing near about that, nothing to worry about right now. India is a growth story, and one can take advantage of these healthy corrections which are happening right now.
Okay. Initially you spoke about timing and opportunity. So let's just take the conversation over there. I want to understand indicators. Are there specific indicators or signals you watch to identify attractive entry points during market pullbacks? When you strategize your clients' strategies, how do you identify those points, Vishwajeet?
See, Kavita, first of all, if you are a disciplined investor, why you need to time the market? That's what my first point. If you are continuing with your SIPs, anyways you are buying at a low. When markets are falling, you're buying, accumulating more units. So that will create wealth, not that you're timing the market. So even if you have to see the indicators, like the one I pointed out, when there is a heavy selling, let's say 30,000 crore is going out of the market, that is the time you should be worried about. Or I would say, if the country is not growing, if the equity, let's say the company's performance is not doing well, like a couple of months back when the earnings were not doing great. So those are the pointers which one should look at. That because ultimately the equity market will perform depending on the earning ratios of the companies. If they are doing well, if the prospects is looking good, if the country's fundamentals are, politically we are stable, inflation is very much in control. So these are the factors one should look at before deciding to quit or add more corpus in the portfolio.
Sure. All right, so that clears the doubt. It is better to invest gradually during volatility, and there is no need to wait for clarity. But then also one very important question: how important is having cash on hand during volatile markets?
Yes, so absolutely, Kavita. First of all, during these uncertain times, when you have given your funds to the professional fund managers, let's say in these times, I would always suggest you should invest in flexi cap funds or I would say hybrid funds. So these fund managers are smart enough to keep certain cash, and whenever there is a fall, they normally invest in those times. But overall, if you really want to do an asset allocation, I think 10 to 15% is something which you can always keep cash, and whenever there is very huge downfall or you see a great opportunity, that is the time you can invest in those dips and you can create wealth. Because it is not always that you will keep the money cash, because they will not give great returns. So you can keep it in a liquid fund and let's see the market, and I would say let the fund managers take a call rather than you taking a call in the markets.
All right. Also, since we are talking about diversification, and since we are talking about having all your asset class in the portfolio, are there any particular asset classes that tend to perform well in volatile markets? Should you be putting, more money in those asset class, having a diversified approach?
Yeah, absolutely, Kavita. In these times, when you feel that the market is little choppy, so what you can do is you can go for a hybrid strategy, where fund managers, let's say balance advantage fund kind of a category or a multi-asset fund kind of a category, where fund managers take a call. If the fund manager feels the market is expensive, they will shift the portfolio more towards debt side. Or if you are in a multi-asset strategy, the fund managers can diversify between gold, silver, debt, equity, or real estate also to some extent. So this is the best strategy when you want to diversify your portfolio rather than you doing it. And in during these times, I would always say your asset allocation should always be there. If your equity portion has gone up, you can always do some profit booking and come back to debt. And if you feel it is too much of debt, then you can, and the market is down, then you can shift towards debt side. But however, I would say ideally the best is you give it to the fund managers to have this hybrid categories where fund managers can allocate between debt, equity, and gold according to the market scenarios and whichever gut feeling they have how the market will perform in the recent future.
Since we are talking about equity and debt category, any specific fund recommendation across asset classes that you've just mentioned?
So I would say HDFC Balance Advantage Fund or ICICI Balance Advantage Fund is a good category to be in, where the fund managers takes a call between debt and equity. And if you are a little more conservative, then you can go for a multi-asset category, and I would say ICICI Multi-Asset Allocation Fund is a good fund to be invested in.
Is there any one single smartest action that one can take today?
See, I would say continue with your SIPs, stagger your investments. Even if you have a lump sum, do STP, which is a beautiful feature in mutual fund, but don't try to time the market.
What is that one common myth about market volatility you would want to debunk right now?
Absolutely. So lot of this is more about investor behavior. When you hear a lot of noise, the market is falling. Normally, people tend to fear that something unfortunate will happen and market will form when they hear the negative news. So stop watching a lot of negative news. Stop watching your portfolio everyday basis and remain invested as long as you don't feel a very big uncertainty is going to happen.
All right, so stagger your investments. A combination of STP, SIP really works. And yes, rebalance your portfolio. Look at the asset classes that are doing well, and maybe you can, slightly go heavy on that aspect of your portfolio. But then that's it as far as this segment is concerned, and the conversation on making the best use of volatility is concerned. Vishwajeet is already with us. He's continuing, and we'll just take a short break. But before I go in for that break, let me just flash our WhatsApp number and email ID where you can send across your questions, because this is the show where we do your live financial planning, a very crucial aspect of your investment strategies. If you want any professional help, our experts are there. Just send across your questions and we will help you formalize your strategies. A short break, and after that, let's focus on your questions. Welcome back. You're watching The Money Show, and it's time to answer your portfolio queries. This is a show where we do your live financial planning with our experts. So just in case you haven't yet noted down our number, the WhatsApp number is flashing on the screen. There's an email ID also. Give us details of your current investments and the financial goals that you would want to achieve through these investments, and we will suggest you the right strategies. We have Vishwajeet Parashar, who's our guest on the show, and will be answering your questions live. Welcome back, Vishwajeet, and let's take Amanullah's question. And he's from Gurgaon, 33 years old, and he's been investing 22,000 per month in Parag Parikh Flexi Cap, ICICI Pru Large Cap, Kotak Mid Cap, 5,000 each in these funds, and he's also investing 2,000 in HDFC Small Cap and Quant Small Cap, and again 2,000 in Motilal Oswal Silver and Gold ETF Fund of Fund. He's been investing since last 4 months now, and the time horizon is almost 15 years. He wants you to review his portfolio, suggest if there are any changes, and he wants to invest more 5,000. That's the plan so far. So congratulations. I think the funds are really good, and more 5,000 he wants to invest a new fund, or you can just distribute the amount in these existing 6 funds.
Absolutely, Kavita. So he already has 6 funds right now, and there are 2 small cap funds which I see in his portfolio. So one is Quant Small Cap and one is HDFC Small Cap. So first of all, I would suggest him he can switch from Quant Small Cap fund to a different investment style of fund which is missing in the portfolio. So I would suggest him SBI Contra Fund, and that is where he can start his SIP and continue his SIP of Quant Small Cap. Otherwise, rest of his funds are top quartile funds. So whether it is ICICI Large Cap or Parag Parikh Flexi Cap, these are all evergreen funds, and I think he should remain invested in these funds and continue his SIPs there. Of course, he can review his portfolio every year. The 5,000 rupees which he wants to invest, I would strongly urge that he can divide 1,000 rupees in all these 5 funds, and he doesn't require a new fund in his portfolio. As long as he wants to know about the kind of corpus he can generate. So right now he is investing 22,000 rupees SIP, and if I see 12% CAGR, if I assume 12% CAGR and for 15 years, which is a good time horizon, he can clearly, I could clearly see 1.4 crore kind of a corpus he can generate. And he has also suggested that he wants to do step up every year. So if he does a step up every year 10% for next 15 years, he can clearly will be able to reach around 2 crores. So absolute number would be 1.91 crores, but I'm assuming if the market does well, he can easily touch 2 crores also.
Absolutely. This is the advantage of timing. You start the investments as early as possible, and yes, a crores is just few years away, and staying disciplined is also the key. So Manullah, that's the portfolio recommendation and advice for you. But then let's move on and let's take Kashif's question. Vishwajeet, he's 32 years old, and he's got a couple of funds. He's been investing through a platform, and he's bought direct mutual funds. He wants to know what's the corpus that he can accumulate. He's invested in Motilal Oswal Mid Cap 2,000 rupees, Nippon India Small Cap 1,500, SBI Long Term Equity 1,500, JM Flexi Cap 1,000, and total SIP 6,000. He can step it up by 10%, and he wants to know if the funds are good and what's the corpus that he can accumulate for 15 years if the same amount is being invested.
Yeah, so I think if he is investing 6,000 rupees, assuming 12% CAGR for 15 years, he can expect around 28.55 lakhs. But I would suggest him, since he's very young and 32 years, and he can easily step up. If he does a step up of 10% again for 15 years, and to really see the power of compounding work, he can create a corpus of around 52.1 lakhs. So almost double what he's getting in 15 years without step up. So I would suggest him do step up and create good corpus. Apart from his numbers, his portfolio looks balanced, but I don't know whether he is into a new tax regime or old tax regime.
Yeah.
If he is in a new tax regime, I think he can stop his SIP in SBI Long Term Equity Fund, which is an ELSS fund, and he can switch this SIP to HDFC Flexi Cap Fund, which is missing in the portfolio. So he already has a GM Flexi Cap Fund, which is not doing great. So I would suggest him, he can have one Flexi Cap Fund, which is HDFC Flexi Cap Fund, and also he can add on his GM Flexi Cap SIP of 1,000 to HDFC Flexi Cap Fund. So this is how he can diversify his portfolio, and strong recommendation to do a step up to create a good corpus.
Absolutely. Step it up and then you can accumulate your desired corpus. Let's move on. Let's take Mr. Anurag Negi's question. And 1 CR in 20 years, 7 SIPs going on, and 11,500 is the amount that he's been investing. So the funds in his portfolio are large cap of Nippon India 1,500, Kotak small cap again 1,500. He's got Kotak mid cap and HDFC flexi cap, SBI balance advantage, ICICI Pru multi-asset, and quantum liquid fund for emergency, where he's investing 2,500. Rest of the funds is 1,500. So superb, Anurag. I think you've got the first step of having an emergency fund. In fact, very few portfolios have this allocation. So congratulations, you've got that right. And in 20 years, 1 CR, you might want to review that goal. But then so far, you've said that and you're working towards it. That's great news. Vishwajeet.
Absolutely, Kavita, you pointed out very right thing, that he has an emergency fund, which is very, very important to start before even investing. So, and even if you look at his portfolio, it's a very well diversified portfolio, and some of the top quartile funds he's having, whether it is the Nippon large cap or Bandhan small cap, Kotak mid cap. So I'm assuming he's watching his show almost regularly, because the kind of funds we normally recommend he has in his portfolio. He also has SBI Balance Advantage Fund, and apart from that, ICICI Pru multi-asset fund. So I'm, I would suggest, since he has a long-term horizon, he can, stop SBI Balance Advantage Fund SIP, because for 15 years he can, create good wealth if he is invested in a pure equity fund. And one investment style which is missing in his portfolio is contra or value style. So I would suggest him, if he can switch his SIP from SBI Balance Advantage Fund to SBI Contra Fund, that would be a good diversification across market cap as well as different investment styles. However, let's look at his numbers. he's investing 11,500 rupees SIP right now, and assuming 12% CAGR, he can easily touch 1 crore because his time horizon is almost 20 years. So 1 crore is a corpus which he can touch, and you rightly pointed out, Kavita, maybe he has not considered inflation. So best way to beat inflation, or to create a corpus which will fit with your goal, I would suggest him if he can do a step above 10%, and if he does that with 12% CAGR, he would easily touch 2.28 crores. So I think he can beat the inflation and create a good corpus in times to come, because he has a good time horizon of 20 years.
Right. All right, very interesting, and all the best over there, Mr. Negi. But then again, a very interesting question coming up, Vishwajeet, and a lot of aspects to this question, especially since we spoke about volatility in the first segment. I think we can connect the conversation over here. This is a question from Karthik. He has approximately 5 lakh rupees, I guess, and out of which he wants to put 4,000 rupees in the market through mutual funds. And he has asked for an SWP. I think what he really means is STP, or maybe if he needs an SWP strategy, then Karthik, if you are hearing us, what you might want to do is just give us the amount that you want to withdraw, which over here you've written is 4,000, but after how many months of investments, or after how many years of investments? If this is 5 lakh from which you want money every month, 4,000 rupees, from when do you want to start it, is the question that we want some clarity to give you an SWP strategy. But then let's weave this question around volatility in terms of answers, Vishwajeet, and also an SWP strategy works well when you are well planned, when you know what's the time frame that you're looking at. Now, putting this money in the equity markets, times when it is volatile, how can you save your principal amount? You definitely want to earn more. You want to do an SWP, which is a good idea, but a lot of red flags over here, if you need that money in short term.
Absolutely right, Kavita. So I am assuming that he's looking for a regular income of 4,000 every month.
Yeah.
And considering the volatility in the market, which we have discussed before, so I would suggest him he can go for a hybrid kind of a category, where the fund manager has a discretion of transferring funds from equity to debt.
A
Or
conservative hybrid, if it's a short term. How do you choose hybrid also in this kind of a situation?
Yeah, so I would, since he's looking for a regular income, so normally we advise our, retiree investors, because if they doesn't want that kind of volatility in their portfolios, and they're looking for a regular income. So pure equity, if he is investing in pure equity, that can be volatile, and it can, at times, change his regular income plans, because sometimes market falls and they become a little giddy, when they're not getting the regular income, or their corpus is depleting fast. So I think this is the way, the hybrid is the best strategy when you're looking for a regular income. And whether it is ICICI Balance Advantage Fund or HDFC Balance Advantage Fund, these are the funds which have given decent returns over the past, and a lot of retiree investors are utilizing this benefit from these kind of funds. So the risk is also a little less, because you have a debt which will bring stability to the portfolio, and fund manager is taking calls depending on the market outlook. So your fund is also in a growth stage, because there is a good component of equity also in the portfolio. So fund is also growing, stability is also coming from debt, and you are withdrawing regular income without getting much disturbance. So these two funds are good. Coming back to the Karthik, I think if he is investing 5 lakh rupees and he wants 4,000 rupees, which is almost like 48,000 rupees per year, and 9.6% of the corpus annually is withdrawing. So I think number of 15 years, if I'm assuming, total withdrawal would be around 7,20,000, and profit would be around 4,80,000. So total amount still left would be 2,60,000. So 15 years, he will get 4,000 rupees per month. His corpus is also growing. His corpus is not depleting to zero or coming to zero, and he's getting a regular income of 4,000 every month also.
All right, so that's the solution for you. But then Karthik, if you need more clarity, we would need more details, because 5 lakhs, if you want to park in for like 5 years, 7 years, and after that you want money, then you have some scope of going directly in equity funds also. Right now, hybrid strategy is recommended, because because we don't have much details on your investments and later on the SWP that you need. So if in case more details is needed, if at all you want a direct strategy based on situations right now. But with that, it's time up on the show today. Thank you so much, Vishwajeet, for taking your time out and helping our viewers with their portfolio queries. And for all our viewers, I'm going to leave you with our WhatsApp number and email ID. Do send across your questions and we will help you, align your investment strategies with your financial goals. Thank you so much for watching. Goodbye.